All right, welcome to this explainer. Today, we're going to get right into a question that honestly, every single renter needs to think about, especially if you live in a place where the ground isn't always, well, solid. So, you've done the responsible thing, right? You've got renter's insurance, you feel all protected. But what happens if the big one hits? Are all your things, your laptop, your couch, everything you own, actually covered? Well, the answer is probably not what you think. Yup, the answer is a big, fat no. That's right, your standard run-of-the-mill renter's insurance policy does not cover damage from an earthquake. And this isn't some tiny loophole. We're talking about a massive gap in your coverage that could literally leave you with nothing. So let's unpack this because you really need to understand why this gap exists. This isn't some accident or a mistake in the fine print. No, it's put there on purpose, and it's called an exclusion. And here's the term you need to know, the earthquake exclusion. You'll find this in pretty much every standard policy out there. Why? Because earthquakes are considered a catastrophic risk. I mean, think about it. One single event could trigger thousands and thousands of claims all at once. That's a huge financial threat to insurance companies. So what do? They just take it right out of the standard policy. And we're not just talking about a broken TV here. The consequences are huge. Your furniture, your computer, all your stuff, gone. But even worse, if your apartment building is damaged and you can't live there, the cost of a hotel, your extra food expenses, that's called loss of use, and it's not covered either. Every single penny of that comes straight from your pocket. Okay, now there is this one little exception, but honestly, it's a huge gamble. Let's say the earthquake breaks a gas line and a fire starts that destroys your stuff. That fire damage might be covered by your standard policy. The key word there is might. Proving that the fire and not the shaking was the direct cause of the damage can turn into an absolute nightmare of a claims process. Trust me, that is not a bet you want to make. But, and this is the important part, the good news is you are not helpless here. There's a specific fix for this. It's a tool designed to plug this exact hole in your financial safety net, and it's something called an earthquake endorsement. Think of an endorsement as just an add-on. It's like a special patch you add to your main policy. And look what it covers. It's basically a mirror image of what's excluded. It protects your personal property, it covers those extra living expenses if you have to move out, and it can even cover improvements you've made, like custom shelves or upgraded lighting. Okay, but here's the biggest difference, and you've got to wrap your head around this one. It's the deductible. This does not work like the normal $500 deductible you might have for theft. Instead of that flat fee, you're looking at a percentage, usually between 5 and 25% of your total coverage amount. Let's just look at an example to make this crystal clear. Say you have $50,000 in personal property coverage, and your earthquake deductible is 10%. That means you have to cover the first $5,000 of damage yourself before the insurance kicks in a single dollar. See? This is not for a few broken plates. This is for a total wipeout. So, to put it really simply, your standard policy's flat deductible is for the small, more common stuff, like a stolen bike. The earthquake policy's percentage deductible is specifically designed for a huge, life-altering financial disaster. Okay, I know what you're thinking. A deductible in the thousands? This must cost a fortune, right? It has to be incredibly expensive. Well, let's actually look at the numbers from the source material, because they might just surprise you. Wow, okay, this chart is pretty eye-opening. Sure, if you're in a super high-risk place like California, it's gonna cost a bit more. But look at the moderate and low-risk states. I mean, look at that. We could be talking 10 to 50 bucks for an entire year. That is literally the cost of a few fancy coffees for protection that could save you from financial ruin. And this is a really important point, especially if you don't live in California. Places that have known fault lines, like the New Moderate Seismic Zone that runs through Missouri, have a very real risk, even if it's less frequent. So for folks living there, the value you get for that low annual price is just, it's off the charts. And here's the thing, your landlord might make you get renter's insurance, but this is almost always voluntary. No one's gonna force you to get it. It really does come down to you looking at your own situation and making a financial decision based on your own comfort with risk. All right, so if you're thinking, okay, I get it, I want this peace of mind, what's the next step? Where do you even begin? Well, good news, it's not that complicated. It's actually pretty straightforward. Here's your 5-step plan to get it done. First up, just get a sense of your actual risk. The USGS has free tools online for this. Then, the easiest thing to do is just call your current insurance company and ask.
If they don't offer it, you can look for a standalone policy. Then just compare the details. Don't just look at the price. And finally, do the practical stuff at home. Bolt your bookshelves to the wall and make a quick video inventory of your stuff. Simple.
You know, this quote from the source material really just nails it. It perfectly captures the whole point. For what is often a pretty low annual cost, what you're buying is a ton of financial security. It's an outstanding value. And that really leaves us with one final question, and this one's for you. Just take a second and think about the total value of everything you own as a renter. Your electronics, your clothes, your furniture, everything. Now, is protecting all of that from a single catastrophic event worth maybe $50 a year? That's the decision you get to make.